Hey everyone, it's Ryder from Skip. There has been a massive surge in layoffs in the tech industry over the past few months. Companies booming with growth over the past couple of years are now cutting their staff by 10%, 15%, and in some cases more. With all these layoffs among large companies, what does this mean for smaller companies and businesses? And if you are a smaller business, should you be worried about this trend or not? In this video, we'll go over the recent layoffs and why they're happening, what this means for the economy at large, and finally, why this matters to you as an entrepreneur or a small business owner and what you can do about it. But before we get started, if you find this valuable in our other videos, please consider subscribing and hitting the like button. Would love to try to get to over 2,000 likes in this video. That's the easiest way to show your support for our channel and our team. And if you're an entrepreneur that needs help growing or funding your business, consider becoming a Skip member, but more on that later. Let's go over the layoffs that have been happening. This trend began around July 2022 when the Fed continued to raise interest rates, and they've been continuing this trend every month since. This led to Shopify laying off 10% of its workforce, which caused its stock to sink by 14%. More and more companies followed suit by first implementing hiring freezes and then typically making cuts and laying off significant portions of their staff. Between Meta, Lyft, Amazon, Google, and Twitter, over 35,000 employees have lost their jobs at those companies alone. Apple so far seems to be the only tech company resisting the urge to let go of a sizable amount of its staff. That being said, Apple has significantly slowed their hiring. So what is this trend all about? For starters, inflation is at an all-time high. Interest rates are at a decade high. Crypto had been crashing and now it's sinking even more after the collapse of FTX. And supply chain disruptions continue to impact the entire global economy. And the economic tailwinds that we had in the US thanks to printing $6 or $7 trillion, giving out stimulus checks, PPP funding, and EIDL funding seem to be a thing of the past. So what does this mean for the economy at large? Well, most experts would agree that either we have been in a recession or that a recession is imminent, and this will likely continue through 2023, and we may not be at the bottom yet. Despite a lot of the economic decline in 2022, the job market had been holding strong for a while as a lagging indicator. Well, we're finally catching up to that lag as employers see the writing on the wall, are tightening their belts, and cost cutting for the first time in a while, starting with reducing headcount. And here's why this is happening now: because of overhiring in 2020 and 2021. During that time period, Meta hired 27,000 employees, Google hired over 20,000, and Amazon added 500,000 employees in 2020 alone. This trend started at the beginning of the pandemic because interest rates plummeted, trillions of dollars were pumped into the economy, and future profits seemed optimistic due to market conditions. Why? Well, because a lot of these tech companies had tailwinds. People were staying inside using online services more than ever before. So we saw massive revenue growth for a lot of these companies. That reality no longer exists. So while these layoffs may seem alarming, it is really more of a correction from the overhiring that took place in 2020 and 2021. US companies overhired. Now they're looking to get back to where things ought to be if the pandemic had never happened. So what does this mean for you and your small business? Well, this may be a time of important change and adaptation for your company. In my opinion, you need to reset your expectations. As we head into 2023, there's a new reality that's here. Small businesses will still be able to take advantage of some funding. In fact, we're helping thousands of businesses still go after good loan, grant, and financing options. But the flip side is we're likely to stay in a recession through 2023. If you're not break even or you're overspending on hires, you should think about how you can get to break even or cash flow positive sooner rather than later, because the cash that is currently in your business bank account is very important. And the best way to do this is a little bit of extra planning for your business. If you think through 2023 and forecast various revenue scenarios for your business, you can use that to gauge whether you should hire more, freeze hiring, or reduce your headcount. Our team at Skip does this all the time by helping people make roadmaps to plan out where they want to be in 12 months and how to get there. And that's the sponsor of today's video, our Skip memberships team. If you want to join the tens of thousands of businesses we work with directly, go to HelloSkip. layoffs.com/join. Use the promo code RYDERINVITE, or better yet, use the link in the description to get a special discount. But beyond that, let me give a few examples right now on how you can better prepare your business for the recession. First off, pricing. As we mentioned, inflation is at an all-time high. We've seen some months higher than 8%. Now might be the right time for you to examine your pricing structure and consider raising your prices. However, depending on your product, you may want to take the opposite approach and lower your prices if you think that will open up a larger audience for you. You can get more people in the door, build a relationship with them, and get them to be loyal customers and increase the lifetime value of them. The second thing you can look at is your funding situation. Maybe you've been self-funding your business and aren't sure if it will be enough to sustain your current employees or new employees, especially if your sales and revenue dip. So having a credit line in place can help be a solid rainy day fund or backup plan for you. Side note, we have a few great partner options there. Links are in the description. You can also apply for other low interest loans, as well as apply for grants, which is a more opportunistic way to get cash in. Oftentimes, even better than applying for funding is taking the necessary steps to increase your position personally. For example, if you're in a bad situation now, raising your credit is often the best first step you can do. We did a whole video on raising your credit. I'll link to that above. And finally, third, focus on your long-term goals. It's easy to get busy doing things that aren't the most important for your business, that don't affect your bottom line, or aren't going to move the needle for your business. So if you don't have these goals laid out, take a step back to form clarity around your business goals. That will inform what you need to do, what your team needs to do, and you can ask yourself, do you have the right team to make that happen, or do you need to make adjustments? Bottom line, it's a great time to assess. And of course, if you want help with any of that, we would be glad to help you. Would love to hear what you think about all of these tech layoffs, and have you had to make difficult decisions for your business, or do you expect having to going into 2023? Thanks for watching and liking this video. Most importantly, stay well, stay healthy, and I'll see you in the next video.